Good Thursday morning, Chameleon community, and here he is, the King Chameleon, Dimitri Pargamonic. How you doing, Dima?
Good morning, Will. How are you?
I think the disclaimer's up. You see the disclaimer?
Yep, I see
All
it.
right, let's start with the disclaimer.
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers, and we're not telling you what to do. If you need professional advice, call your broker. That's what they're there for, to help answer questions and provide you with guidance. There's the disclaimer. And
All
with
right.
that, let's get started. And I think today we'll open it up for Q&A. I think we've been having some people trying to ask some questions we didn't catch at the end of the day. So if you guys have questions, put them in the live chat. Will's monitoring that. He'll read them back to me. If you want to ask your question directly, we're putting out a link to Zoom on the YouTube channel. If you click over, you could raise your hand. This way we could hear your question live. You don't have to turn on your video camera, but you could ask your question directly. So those are the two ways to ask. While we're waiting for any questions to queue up, what I'll start doing is just taking a look at what's going on in pre-market hours, and maybe go over some reports that we don't really reference that much. So just to kind of take a peek at it, get some insights about the general market. So let's get started with the pre-market report. These are stocks trading in the pre-market hours. We have the most active stocks, the biggest percentage gainers, biggest percentage decliners. Coming down here, taking a look, 42 stocks made the percentage gainers list, 109 stocks on the percentage decliners list. So from that perspective, looks like we have more bearish bias for the open. I'm going to take a look at what's going on in S&P 500 stocks. So let's filter these lists by components in the S&P 500. I'm going to drop down this filter. I'm going to select SPY. So that's the S&P 500 ETF. And oops, let me just refresh my screen here. And that will filter out S&P 500 stocks. And here we see 2 made our percentage gainers list, 14 on the percentage decliners list. So not a huge list, but nevertheless more bearish than bias for the opening. No questions. I know it's still a little bit early. We're in a little bit of a delay. So
we did get a typed in question. I answered before,
okay.
But they're asking about the time delay on the pre-market prices.
Right. So the time delay on the market prices on the website is at least 15 minutes. So all the prices, market prices are 15-minute delay. Some people ask me, well, are other parts of the website delayed? Like, for example, let's say news scanner, right? So we got news here coming out. That's not on a delay because that doesn't come directly from the exchanges. Those are coming in from different feeds. So we subscribe to different feeds that we bring into the website. So we go out there and, for market data, you get those from the exchanges. They have their own rules with what you can do, how you can display the data, the time delays. We don't actually set those rules. We just comply with what the rules are, according to the licenses from the exchanges. So once they tell us this is what you can do, this is what you can't do with the license, that's how we comply with those rules. But for example, press releases, they don't come from the exchanges, don't control that. And when we talk about market data, it's not just exchanges. The exchanges are very close to the SEC, and that's part of the rule book. So all these things that the exchanges we comply with, though, they go to the SEC and the consolidated tape. You could go look; it's on the SEC rule book. As far as like non-market data, like news, those are not coming from the exchanges. Those are coming from press release agencies like PR Newswire, Global Newswire. We subscribe to their feeds, and those they don't have that kind of a rule that you have to delay it. they don't make that kind of rule. Or our analytics, those are not delayed because we could run the analytics. We just can't do it on a real time data. Okay, so we just comply with those rules that they set. I think some people think like we're the ones who control it, but it's not us doing it. We're just complying with exchange rules and the licenses on those.
Yeah, no, that was a perfect answer, D. We did. Okay. Trevor asked a question in the YouTube. He's saying, can you discuss how to find option skews and how you use it, meaning how would Dimitri use option skew?
So, we've been talking about option skew a little bit in the last week. What is an option skew is basically when we compare different options and how they measure up relative to each other, right? So how's this option premium price relative to an option premium of a different option? So we'll start with just an example of a visual. So let me go to the options chain here. And I'll use SPY for an example. So let's go December 15th expiration. So here we have 5 days left on this, 5 trading days left in this expiration. And for people who maybe not understand exactly the option skew, when we're looking at, there are different option skews, by the way. There are option skews within the same expiration. We call that like a vertical, where we could compare one strike versus a different strike. And there is horizontal, which is looking at the difference in the expirations, right? So it's kind of going out through time. That's a horizontal one. So let's take a look at the skew within the same expiration, right? So now we're looking December 15th. So all these options will expire on the same day. Okay, so we don't have to worry about the expirations, but what we see is that, well, there are different strikes. I got all these different strikes, and each of these strikes has a different price to the option, rightfully so. They shouldn't be all priced the same. But how do I know relative to each other which one is priced higher or lower? And we kind of use that options model, the Black-Scholes. You can use binomial, and what it will do is convert the price of the option into an implied volatility, right? And saying like, well, based on this price and all the assumptions in the option pricing model, this is the implied volatility of that option. And by doing that, then we could compare the implied volatilities of the options. So if I'm going down here, and you could see here the different strikes, as I go lower in strikes, I could look at the options prices, and then I could compare their implied volatilities. And I see that as I'm hovering over, the implied volatilities are moving higher. Okay. And if I'm going up in strikes, I could look at the implied volatilities of the calls, and I could see that the implied volatility of the calls are moving down in implied volatility, meaning that it's not only the price, right? The price will change, obviously, because as you go out further and further away, you're going to pay less premium, but the relative premium is changing too. So what is the skew? The skew is comparing, well, how much more implied volatility is one option getting versus another option. Okay, that's the implied volatility skew, because you would think theoretically, right? And the people who actually created the Black-Scholes model, they were under the assumption that all options should have one implied volatility. You shouldn't see skew, because a stock, from today to expiration, the underlying itself is only going to have one volatility. It's not going to have 10 different volatilities. In the next 5 days, we're going to see the stock, whatever it moves, that's going to be its implied volatility. So in theory, we're like, well, why does one option get priced more than a different option in implied volatility terms? And over time, they actually almost, I think that they went out, the original hedge fund that was trying to do this actually blew out, right? When they tried to say, okay, all options should have one volatility. So they would just buy the cheaper implied vol, sell the higher. And
is that long-term capital?
yeah, long-term capital. They had to get bailed out. All right. That's what they thought. They thought that they were just arbing, by buying the cheaper implied vol, selling the higher implied vol. And the market ultimately was correct in saying that there should be a skew in these options. And why is there a skew? Well, even though, yes, it's going to have one volatility, SPY will have one volatility in the next 5 days, but the expectation is based on where the stock is moving, the volatility is expected to be different. So, for example, as we're moving up in price, if we see a lot of stock on for sale, right? If we see a lot of offers and plenty of stock to buy as you're pushing the prices higher and higher, then it's going to move slower, right? But if we don't see as many bids below, right, where if this thing starts falling and there's not as many bids sitting there, then it's expected to break a certain point and fall faster. Okay, the liquidities are different, and that's why the expectations of the volatility, depending which way the stock goes, is changing. So just so you guys know, usually this is what the SPY, the implied volatility, is going to be. It's going to look this way, right? As the stock is going higher, you're going to see implied volatility is moving lower. As the stock is moving down, implied vols are moving higher. And then the question is, if this is the usual case, right? If there is the case where this implied vol, right? I'm going to just put this in here, selling a put 1.2% out of the money. Let's do that. I'm going to sell this put 1.2% out of the money. And let's just say I do equivalent by a call here. It's either this one or this one, almost the same distance away. Let's just say let's do 476, and I'm gonna buy the 476 call. Okay, so I'm selling the 464 call, buying the 476 call, and I could see here that if I'm selling this on a relative basis, I'm selling it at a higher implied volatility than I'm buying this. All right, so I'm going to run that, and this is a risk reversal. Right, this is kind of a risk reversal. You could, and by the way, when you guys are doing call spreads and put spreads, some of it is you are trading skew, right? So there's a skew involved in call spreads and put spreads as well. But this one's maybe a little bit easier to see, and you could see that I'm selling here, collecting $1.77, buying this, paying 90 cents. So on a relative basis, I'm collecting more than I'm paying out the put relative to the call. And the question is, well, is this skew that I'm seeing right now, how does that skew compare to historical skew in SPY, right? Because if I'm already expecting it to be a skew, has that skew gone spread out more? Is it cheap or expensive relative to historical levels? And for that, here's what needs to happen. I need to go back in history and use the snapshots in my database to say, okay, with 5 business days left to expiration, right? Because the days left to expiration plays a big deal in it, right? That's different than 30 days, 90 days. With 5 days left to expiration, and with options that are strikes the same distance away from the spot price, right? That's what I need to find out. This distance and this distance. Go find all those. I have to run that regression every day, find the relative implied volatilities, and then compare that history to today, right? And that's what the IVT is doing. So I'm coming down here to this IVT, and just to give you guys an example, what's going on here, is a very intense calculation, right? That's it's not an easy thing, to do, to run this, because an implied volatility is something different. Implied volatility is you take a model, you put in inputs, and then you get an implied vol. This actually is way more intense because you're taking snapshots, cleaning up data, running regressions, doing all this stuff. So this is a way more intense calculation. But let's just take a look at what the history tells us. So in the last 4 years, and our model is going back and saying, okay, we need to figure out an estimate with 5 trading days left. What is an implied volatility for spot price 1.2% to the downside with 5 days left to expiration? What is the implied volatility for a strike 1.3% above the spot price? And then we got to go back, look at those observations, right? So we have to also sync them up, right? Because we need a snapshot at how did they compare at exactly the same time? So the important thing is also that if we're comparing two different options relative to each other, we got to, in history, make sure that we're actually comparing them at the same time simultaneously. And then we take those implied vols, right? Here you go back into history. And then if we use those implied vols and apply them to today's, and convert them to today's prices, then we get a theoretical value for that spread, right? Because the spread is buying one, selling the other. Now, some of this, right, what is the model also doing is saying, okay, I'm using a dynamic model. And in this dynamic model, what it's also doing is taking other things into consideration, right? Because when we're looking at historical data, well, what are other circumstances in that historical data, that I could apply today? So for a regular stock, has an earnings. SPY doesn't have an earnings, so that one won't be relative in this analysis. But if it did, that model would have to compensate and look at similar situations, and if it doesn't have an earnings coming up in this expiration, the model will have to go there and look at periods with no earnings. In addition to that, what it's saying is, well, right now, what is the general implied volatility at? And it's looking at the skew based on this general implied volatility. So the skew can change as implied volatility itself is moving up and down, right? The money moving up and down, the skew will change as well. So what we want to know is, okay, given similar circumstances, what do we usually see the skew? Okay. So all this stuff has to happen in the background to get us a better estimate. So we see here that on average, that this spread would have brought in a credit of 85 cents. Right now, it's a credit of 87 cents. So it's really kind of in line with that historical, right? And we could see the range in the last 4 years. So the range is negative 30 cents to negative $1.53. So, it's kind of a wide range, right? We're right in the middle, kind of. We're not near the high or low, but but we're kind of right there. So that kind of gives you from a historical perspective, where the markets are lining up right now. Any questions there? And for this analysis,
we did have a question, Rob, when the risk reversal, what is the downside? Is it if the stock falls to zero, then what is the downside loss? He was asking.
Well, in the risk reversal, because you're just selling a put and buying a call, then on the downside, once it goes, below your strike, it's that the downside is the stock could go to zero and you're going to lose whatever the
difference between the strike price and the zero.
It's like selling a put, right? In this scenario, if you do a call spread or put spread, it'll be different. So it depends on the strategy.
Just like being long the stock.
Yeah, it's kind of like being long the stock in a risk reversal. But I just wanted to show you an example of skew, because the risk reversal is kind of the easiest place to show you the skew. That's kind of like a straight, here's one option to the upside, one option to the downside, and there's a skew. And probably in SPY, you're going to see one of the biggest skews between upside and downside is in SPY, because naturally hedging activity, right? If you're hedging against downside or trying to, you go into the SPY, right? Protect your portfolio by buying puts or by writing it. So there's a lot more options, a lot more liquid in the SPY, so you can kind of see that skew much better. And the options are much more liquid, they're tighter. So that's kind of an example. And what I showed you right now, it would be really, there's too many combinations, right? You can't screen for every single combination here, and you can't screen for every, because I could come in here and start changing some of these assumptions. I could go for 1 year.
It's funny because Rob made another. He wondered if you would look to buy a put further down. Talk about changing assumptions, right?
Yeah.
That downside loss concerns him at some point, as it would everyone. He's wondering if you'd look to buy another put below to kind of cut that tail off.
Right, exactly. And that's how kind of you start looking, right? Well, here's my position. Where do I want to shove myself? Maybe I buy down here. Do I go over there and, buy another put somewhere below, then run that strategy, so then, you basically stop yourself out over here. So there are different ways to do it. And, when you're trading options, once you start trading, you have a position, right? You have risk, and a lot of your trades will start going, based on your risk, it's going to kind of drive what you're trying to do as well, right? So I'm just showing you an example of a strategy, but your positions will be also a major factor in your decision making, right? Because you're not going to just want to do something that just keeps accumulating risk exposure to one, either the market moving one way or the implied volatility moving one way. So it's like playing chess, and then once you start playing chess, the pieces are moving around, and then your decisions are going to be based on what the changing factors on the chessboard, right? And that's kind of like your position will play a factor into your decision making. It always does, and you want to start thinking about that moves ahead, right? Like if I'm putting on this risk, what is my position? How does it change? Is it reducing my risk? Is it increasing my risk? What is my compensation? Sometimes you have to, give up some edge to reduce your risk. And that's what you're kind of always doing. And I'm just showing you things in isolation, right? So you could kind of just take something and start analyzing it. Okay, so that's and it's going to depend on your outlook, right? Your risk, your outlook, changing information. Your outlook could could change based on factors, that you thought certain things were going to maybe play out some way, maybe it's playing out different way, new information came out, and those all go into your decision-making process. But what we're doing is just taking one thing at a time. Is that
it's interesting looking at, we talked about option benchmarks last week, and one of the features in there is obviously the benchmark or the risk reversal. It's an interesting place to take a look at it. But we did have, I don't know, we only have about 5 minutes left. We did have a question from a new Chameleon who popped in today.
Sure.
And he was wondering, RH, I just had earnings. He was wondering how, if someone was going to play the vol crush, how they would have done it. I think, it probably will occur right at the opening, but maybe you could walk through a quick commentary on vol crush in a stock that just had earnings.
So here we have, so this is RH, right? They reported earnings. I'm just going to take a look really quickly here on the earnings. And let's just see here, what it did here. And it looks to me like that this move to the upside right now in a pre-market exceeds what the straddle was implying so far, right? So we'll see where it opens, but it looks to me like, maybe we're going to exceed what that straddle was implying. But let's say that then it's over, right? So whatever the straddle was yesterday, it's at a new price, but where should implied volatility, settle is the question. And remember, when we talk about implied volatility, the further you go out, the more implied volatility is relevant, because as you get closer and closer to expiration, it's really mostly gamma, right? The implied volatility is less of a factor. The movement is more of a factor. So let's just take a look at what it did historically. So here this historical implied vols, and we look at the 30-day IV. So an option that expires 30 days out. Okay. And how does that option tend to behave? So after reporting earnings, historically, we see it decline the 30-day IV by 30%. That's the average, right? Day before, historically, the 30-day IV was 75.2. Day after earnings, 53.6. And I do see here yesterday we're 65.1. So we were, below that average already. And we see that 5 days later, the implied volatility was lowered, so it continued lower. That's what this is telling, that even at the day after it dropped, 5 days later, it continued to drop. So let me just come down here, right? So this is where we were yesterday, 65.1. You could see historically, this is, you could see historically right here, the last three, I think the stock did something similar. It was up after reporting earnings, and you could see how it dropped by the end of the day, right? The day before, end of the day, we could see here, average day before, average day after, we could see high and low end, right? And we could kind of see what did it do the following day and heading 5 days out. So this gives you some sort of historical perspective of how the implied volatility tended to behave after reporting earnings, right? I don't know where it will open up today, so you got to kind of take a look and, make that judgment, but you do have a historical perspective of the average move to the downside, the range, that it had, and also how it tended to move going out a week after. Hopefully
perfect. That was super helpful, dude. Great question and answer day. Awesome.
Well, thanks everyone for joining. Stay safe out there. Hope you guys have a great trading day, and we hope to see you tomorrow. All right.
All right. We'll see you tomorrow, everyone. Have a great trading day. Thanks so much, Steve.